ったんだ
Hey guys, it's Charles back again. So last week we spoke about what are the risks in investing in real estate. We talk about, having your expectations set for market drop and working with the wrong people. The Ontario Residential Tenancy Act is favoring towards tenants rather than landlords. Government intervention, location, small towns to avoid, and we talk about hedging your risk. This week, we're gonna go back and talk about how to buy. So if you have had chance to figure out your why you want to invest in real estate, and you understand how much money you can make, and that you can build wealth long term, and you understand your risk. Now, if you're ready to dive in, let's chat about how to buy. So first thing we're going to talk about today, we're going to focus on financing. So real estate investing and financing goes in hand to hand. Basically, if you can't get financing, then you can't invest in real estate unless you have cash to buy, which for many people starting out is almost not possible. So financing is very, very crucial. So we're going to spend some time here today. Just disclosure, I'm not a mortgage broker. I don't work for the bank. This is just my high level explanation on what I think the financing options are. Okay, so let's get into it. First thing first, you need to understand where your down payment, or in investment terms, where your seed capital is coming from. Right? So where's your down payment coming from? There are a couple of sources. Many investors, they have or they own their principal residence. So you may have equity in it, and you can turn an equity into a secured line of credit, which you can access as form of down payment for your investment property. Second will be cash savings, right? This is just the regular savings in your savings account. If you're buying for your first time, you may be eligible to use a registered fund like the RSP, right? The down payment could also come from gift, so your family may be able to gift you as a way for you to get started. Or you could partner up with a friend or a real estate investor to fund your first deal, right? A lot of people around me, I know they have good jobs, good credit, but they just don't have the down payment, right? So if you can partner up with a friend, or if you can partner up with a real estate expert, that could work too. Somebody does the funding. This is a deeper topic. Mainly it's referred as a joint venture agreement. So we're not gonna dig deep into it for now, but just know for now, if you don't have the down payment, you could have your purchase agreement structured in a way that you can bring in partners. And there's pros and cons for that too. And do you need renovation, right? So if you need a renovation, make sure after you pay your down payment and your closing cost, you have the capital left for renovation, right? Where's that going to come from, right? And one great product most of the bank has, it's called the Purchase Plus Improvement Loan. So basically, that's just the bank saying, you know what, we will pre-approve you on your renovations because you're improving the value of the house, and if you do what you said you will do, and the house gets renovated and it's in a state that is much better than before, we will lend you that amount. right? So it's a great program. However, you still need to fund the renovation cost first. Like you have to pay your contractor first in stages, and the bank will come, make sure you did what you say you will do, and then you have to submit the receipts. And if it's all good, they will release the fund for whatever amount you spend on the renovation in stages, right? So that's for down payment. And now, typically, we're putting down 20% as an investor and we're borrowing 80%, right? So this here is we're talking about the 20%. Now, for the rest of the 80%, most of us requires a mortgage, right? If you don't need a mortgage, you pay by cash or line of credit. But if you need a mortgage, there's certain options. The first thing everybody think of is let's go directly to the bank, right? So maybe your mom, your dad has a previous relationship with their principal residence, and you have the bank representative already. Now, keep in mind as an investor, um, going to the bank, there's really two ways. There are the people who works at the branch, they're kind of employees, they're on site at the branch, and there are also mobile representatives for that bank, right? And in my experience, these people who are mobile rep, they will work much harder, and they're a little bit more creative in getting you the loan that you require than the people who works at the branch. Okay. However, the real way to go about it as an investor is really to work with a mortgage broker, right? So a mortgage broker has access to most of the A lenders, just like the banks that you went. Plus, they have access to B lender, mono lender, or private lenders, right? So why go to a bank when they can only talk about the product or service that they have at that branch? Yes, it happened before between the same bank. If you go to a different branch, they will have different products. So why shop around yourself when a broker who is experienced in this and already have a relationship can go shop around for you on your behalf, right? So A lender is basically the mainstream guys, you know, TD, RBC, CIBC, BMO, those kind of place, right? And B lender, mono lender. So if these are the guys you go to after you've exhausted your options with the A lender, right? Sometimes maybe your credit is not good enough, or your income is just not there yet, or you've bought too much properties that your ratio isn't working out. A lot of times, a B lender or a mono lender who only does mortgages, they are most likely to approve you on a loan. So know that for these guys, they're typically charged 1% lender's fee. That's a flat fee on the borrowed amount, right? And also their rate is a little bit higher than A lender, but still it might still work. Like right now, the rates are super low. The primary rate is very low, so even if you go to a B lender, it's still very attractive if you can get that loan. The terms for B lender are usually shorter. I've seen like 2 years to 3 years instead of like 5 years like the A lender. So it's really there. You get in, you know, temporary just to buy you some time, and after the terms are up, you can go back to an A lender to secure long-term financing, right? And also, last but not least is your private lenders. So these are the guys you go to for a high interest but short-term borrowing. It's perfect for renovations, right? You're in from 3 to 4 months. You just need a quick loan, no other terms. Then a private lender could be a perfect option for you. and you can unlock a lot of the stuff that you can't before. There's also something called a vendor take-back loan. So that just means when you buy a house, right? Usually with the purchase amount, you will get a new mortgage, and that mortgage would pay off the existing mortgage that the seller has, right? But for this vendor take-back loan, basically you're saying that as a buyer, I'm not getting a new loan from the bank, but instead, let me assume the seller's existing mortgage, right? And you pay them a little bit higher interest rate, so that basically you buy the house as like normal, but your your mortgage will come from the seller, right? So the seller would hold on to the existing mortgage on your behalf, and you're paying them for with a little bit more of interest rate. Why would a seller agree to that, right? There's many reasons, right? Maybe the seller still have a good job or have business income somewhere that he doesn't want to pay a huge capital gain on top of that for that year. So by having you hold on to their existing mortgage, it can delay the capital gains for selling, right? Also, it buys time for the buyer to secure long-term financing, right? So maybe right now at this moment you're not able to get a loan from the bank, so you get this vendor take back mortgage, 1 to 2 years, and after that hopefully your situation will be improved such that you can go and secure your own lending from the bank, right? The con is that it is very difficult to get accepted offer, especially in Ontario, where most of the markets we invest in is a seller's market, right? But yeah, so most of the residential properties, the seller will not want to continue carrying a mortgage. They just want to dismiss. They want to sell. They just want to move on and get the proceeds, right? However, this might not be the case if you're looking at commercial or bigger buildings. So it isn't a strategy I want you guys to keep in back of your head. But most likely in Ontario, if you're investing in the major towns, this will not work, right? But the idea is, you have to think creatively, and this strategy could work if you can come up with a win-win scenario for both the seller and the buyer. Okay, another way to get mortgage we spoke before was getting a partner. So we spoke about, partner who will contribute to the down payment, and now we're talking about partner who will contribute as a person getting the mortgage for the deal, right? So I actually have a recent example where we bought a condo. Okay, it's for my brother, younger brother. However, his credit's good, but his income is still fairly low because he recently just graduated. So we did a partnership where I qualified for the mortgage, and my parents paid the down payment and the closing cost. So they contribute to the capital, and that way we were able to close the deal, and my brother just have to move in and carry the mortgage, right? He's responsible for paying the mortgage, the insurance, the property maintenance. It's a condo, so there's a maintenance fee, right? And land tax as well. So this is an example where you can do a partnership. You can do it within families, or you can work with your friends or other investors. The moral of the story is that before you get in investing, you need to be speaking to a mortgage broker who specializes in real estate investment, right? I think majority of people will just go to the bank directly, but honestly, if you want to scale and if you want to be continue to be able to buy properties and not get stuck, you have to be speaking and working with a mortgage broker who specializes in investment, right? So the first conversation you're gonna have with them will be figuring out how many can I qualify, how many house can I qualify with the current financial situation, right? And come up with a plan, right? Um, how many can I buy this year? How many can I buy next year? What does my loan to value looks like? You know, where do I need to cut in terms of expense or liability, and where do I need to improve in terms of income, right? And building a relationship, just like building a relationship with a investment focused realtor, it is very important to have a relationship with an investment focused mortgage broker, because without financing, again, you will not be investing, right? Because the biggest, most important, most critical thing about real estate investment is leverage, right? So the way you leverage is you borrow a loan at a cheap rate. Okay. And you know what? Never give up if you get a no. You might have mortgage broker or bank telling you, no, you know what, Charles, you are done. Like there's no way we can get you loans anymore. Never ever give up. Always seek for other opinions and always try to improve your situation. So that's why, again, building a relationship is very important, because the difference between the mortgage broker who will kind of squeeze your numbers and try to push for one more mortgage, versus somebody who just take a look and say, you know what, your ratio is not good, just on the surface, could be the difference between getting another deal or not, right? So there's always a way, and the financial world is always changing, and the bank rules and how they calculate and how they run the approval ratio, that's also changing as well. So having a good mortgage broker on your side is key, right? Um, at the beginning, you might be tempted to over leverage, so you might be doing like 5% down deal, so you're borrowing 95%, right? The thing is that if you over leverage, and when the market shifts, um, you could be left in a very difficult situation. So always, I would say you start off minimum 20% down, and eventually you'll work your way down to paying down that debt. So a healthy, leverage would be, 40 to 60, or like 50-50. Those will be a very healthy leverage, right? Okay, hopefully you find some value in this. If you enjoy it, please download your free copy of deal analysis sheet. I'll leave the link at the comment, and please subscribe. Thank you very much. Bye for now.